Tokenomics. Why do some crypto projects succeed while others fail, even when their charts look almost the same? In our last video, we broke down technical analysis, which helps us read the charts and spot trading opportunities. But charts only tell half the story. They can show us what is happening, but not always why it's happening. That's where fundamental analysis comes in. FA is the secret to spotting long-term winners in the crypto world. It's about looking beyond the candles and digging into real-world factors like a project's purpose, adoption, tokenomics, and the strength of its community. In short, it helps you separate hype from true value. And if this is your first time here, welcome to Crypto Education Zone, where we break down the crypto market in simple, practical ways to help you invest smarter. So stick around, because by the end of this video, you'll understand why fundamental analysis matters most for crypto investors, and how it can give you the confidence to make better decisions in a market that's often full of noise. Fundamental analysis in crypto is all about digging beneath the surface of a coin or token to understand its true value. Instead of just staring at price charts and short-term market movements, FA asks a deeper question. What is this project really worth, and does it have the potential to grow over time? In traditional finance, investors use fundamental analysis to evaluate stocks by looking at earnings, revenue, and company growth. In crypto, we don't have balance sheets and quarterly reports in the same way, but we do have things like white papers, blockchain data, token distribution, developer activity, and community adoption. All of these provide clues about whether a project is solid or just riding on hype. To put it simply, FA is about studying the intrinsic value of a cryptocurrency. Think of it like researching a new restaurant before you decide to eat there. You don't just look at the outside sign or a flashy ad. You want to know who the chef is, what kind of food they serve, whether people are lining up to eat there, and if the restaurant is built to last. Crypto works the same way. A project with a strong team, real-world utility, and a healthy community is like that restaurant with rave reviews and loyal customers. Meanwhile, one that only thrives on hype with no real product or roadmap is like a flashy restaurant that looks good on Instagram but has terrible food. It might attract people for a while, but it won't last. This is very different from technical analysis, which focuses on price movements and patterns. TA looks at charts, candles, support, resistance, and indicators like RSI or moving averages to predict where the price might go next. It's useful for short-term traders who want to take advantage of market swings. But the problem is, TA doesn't tell you if the project itself is worth holding for the long haul. You could analyze the chart of a meme coin and find entry and exit points, but that doesn't mean the coin itself has long-term value. FA steps in to balance this. For example, let's imagine two tokens, token A and token B. On the charts, they both look similar. Each one has risen 20% this week. A technical analyst might see the same patterns on both and trade them alike. But if you look deeper with FA, you might discover that token A is part of a project building real-world blockchain solutions with a strong developer team and a growing user base. Token B, on the other hand, could just be a meme token with no use case, controlled mostly by a few whales who can dump at any time. Both charts might look attractive in the short term, but only FA reveals which one has the potential to thrive over the long term. Another way to understand the difference is to think of TA as checking the weather and FA as studying the climate. The weather tells you what conditions are like today or tomorrow, which is helpful if you want to know if it's safe to go outside. But the climate tells you whether a place is livable in the long run, whether it's fertile, safe, and sustainable for the future. In the crypto world, TA is great for timing your entries and exits, while FA gives you the confidence to hold on to projects that can truly survive the test of time. That's why both methods complement each other. Traders often use TA to find the best buying opportunities, but they rely on FA to choose which assets are worth buying in the first place. Without FA, you might end up trading projects that look good now but collapse tomorrow. Without TA, you might believe in a good project but buy at the wrong time. But with FA as your foundation, you can filter out the noise and focus your energy on assets that stand a real chance of shaping the future. Now that we understand what fundamental analysis is and how it differs from technical analysis, the next step is learning how to actually apply it in crypto. Fundamental analysis isn't just a concept, it's a structured approach that helps us dig deeper into a project's true value. In fact, it's built around 5 key pillars, and in the next sections, we'll explore each one in detail, step by step. By the end, you'll have a complete framework for evaluating crypto projects beyond the price charts and hype, so you can spot the ones with real long-term potential. Number 1 is the project fundamentals. When it comes to fundamental analysis in crypto, one of the first things you want to examine is the project itself. Every cryptocurrency begins as an idea, and the strength of that idea, plus the team behind it, can determine whether the project survives the wild ups and downs of the market. This is where you look beyond price and hype to ask, what is this project really about, and does it solve a problem that matters? A good place to start is the white paper. In traditional companies, you might look at a business plan or an investor pitch deck. In crypto, the white paper serves the same purpose. It explains what the project is building, why it exists, and how it plans to achieve its goals. For instance, when Bitcoin's white paper was published by Satoshi Nakamoto in 2008, it laid out the vision of a decentralized, peer-to-peer digital cash system that didn't rely on banks. That wasn't just a random idea. It was a revolutionary solution to a real problem in finance. Compare that to many modern meme coins, which often have no serious white paper at all, or release documents full of buzzwords with no clear roadmap. By reading the white paper closely, you can usually tell if a project is serious or just trying to ride a trend. But even the best ideas won't work without the right people. That's why another important factor is the team behind the project. In FA, you want to know who's running the show. Do the developers and founders have real experience in blockchain, finance, or technology? Are they transparent about who they are, or are they hiding behind anonymous usernames? To illustrate this, think about Ethereum. Vitalik Buterin, the co-founder, had already been writing and speaking about blockchain for years before Ethereum launched. His credibility and the expertise of the Ethereum Foundation gave investors confidence that the project wasn't just smoke and mirrors. On the other hand, when you see projects where the team refuses to disclose their identity or their LinkedIn pages don't check out, that's a major red flag. Another critical aspect is the problem the project is solving. Strong projects are built on real-world utility. For example, Chainlink focuses on providing decentralized oracles, which allows smart contracts to connect with real-world data like weather, stock prices, or sports scores. This is an essential service in the blockchain ecosystem, and it's why Chainlink has been integrated into hundreds of platforms. Compare this to a project that launches just to be the next Dogecoin with no unique use case. If the only goal is to pump the price and attract hype, the fundamentals are weak, no matter how strong the marketing might seem. Step by step, here's how you might approach evaluating project fundamentals. Step 1. Read the white paper carefully. Look for clarity, vision, and a realistic roadmap. Step 2. Research the team. Check their background, track record, and how transparent they are. Step 3. Identify the problem they are solving. Ask yourself if it's a real urgent need in the crypto space or just a recycled idea. Step 4. Look at the competition. Even if the project solves a real problem, are there already 5 other projects doing the same thing better? When you take these steps, you begin to see the difference between projects built to last and projects designed just to make noise. For instance, during the 2017 bull run, thousands of ICOs launched with flashy promises. Many of them raised millions but collapsed within a year because they had no real use case or credible team. In contrast, projects like Cardano or Polkadot that focused on building solid technology and solving scalability or interoperability issues are still around years later, continuing to develop and attract users. In short, project fundamentals form the backbone of fundamental analysis. A flashy price pump can make anything look good in the short term, but only projects with a strong vision, capable team, and genuine utility stand the test of time. By focusing here first, you filter out most of the noise and save yourself from chasing coins that are destined to fade. Number 2 is the tokenomics. When analyzing a crypto project, one of the most important layers to understand is tokenomics, which simply means the economic design of the token itself. Even if a project has a brilliant idea and a strong team, its tokenomics can make or break its long-term sustainability. Think of tokenomics like the rules of the game. It defines how tokens are created, distributed, used, and destroyed within the ecosystem. If the rules are fair and well thought out, the game can go on for years. But if the rules are broken or one-sided, the project risks collapsing under its own weight. One of the first things to study is the supply structure. In crypto, not all tokens are created equal. Some have a fixed supply, like Bitcoin, which has a maximum of 21 million coins that will ever exist. This scarcity is part of what gives Bitcoin its value, similar to gold. People know that once all coins are mined, no new ones will flood the market. Other tokens, like Ethereum, don't have a capped supply, but introduce mechanisms to control inflation. For example, Ethereum's EIP 1559 update burns a portion of transaction fees, creating deflationary pressure that balances new issuance. On the other hand, many low-quality projects create tokens with massive supplies, sometimes in the trillions, just to make their coin look cheap and affordable. This often tricks new investors into thinking they're getting a bargain, but in reality, the huge supply makes it nearly impossible for the price to rise meaningfully. Beyond supply, you need to look at utility, or what role the token plays within its ecosystem. A strong project doesn't just issue a token for speculation, it gives the token a real job. Take Binance Coin, BNB, as an example. Initially, BNB was created to give traders discounts on trading fees within the Binance exchange. Over time, its use cases expanded to include transaction fees on Binance Smart Chain, staking, and even real-world payments. This constant demand for the token adds to its value. Compare that with a project where the token exists only as a placeholder with no clear use. Such tokens often struggle to maintain interest once the initial hype dies down. Another crucial part of tokenomics is distribution. How are the tokens shared between the team, early investors, and the public? A project where insiders hold most of the supply can be very risky. For example, if the founding team controls 60 to 70% of all tokens, they can easily dump them on the market when prices rise, leaving everyday investors with heavy losses. Stronger projects usually allocate tokens more evenly, some for the community, some for development, some for partnerships, and a portion for the team with a vesting schedule. Vesting schedules, where team tokens unlock gradually over time, show that the developers are committed to the project's long-term success rather than a quick profit. You should also consider whether the token's design encourages inflation or deflation. Inflationary tokens release new supply into the market constantly, which can reduce value if demand doesn't keep up. Deflationary mechanisms, like token burning, reduce supply over time and can increase scarcity. For example, Shiba Inu introduced a burning system where tokens are permanently removed from circulation to boost long-term scarcity. While token burning doesn't guarantee success, it often shows that the project is thinking about long-term value, not just short-term hype. Step by step, here's how you might analyze tokenomics. Step 1. Check the total supply and circulating supply. Is it capped, inflationary, or deflationary? Step 2. Examine the token's utility. Does it play a real role in the ecosystem, or is it just a speculative chip? Step 3. Investigate distribution. Who holds the tokens? Is there a fair spread or concentrated whale ownership? Step 4. Look for mechanisms like burning, staking, or rewards that influence scarcity and demand. For example, let's compare Bitcoin and a random meme token. Bitcoin's tokenomics are simple yet powerful. Limited supply, predictable halving events that reduce issuance every 4 years, and growing utility as both a store of value and payment method. That's why it has lasted over a decade and continues to dominate the market. A meme token, however, might launch with 1 quadrillion tokens where half are given to insiders and the rest are airdropped to create buzz. It might pump in the short term because of hype, but the weak tokenomics make it unsustainable in the long run. In summary, tokenomics is the heartbeat of a crypto project. Without strong tokenomics, even the best ideas can struggle because the token that powers the ecosystem has no lasting value. But when supply, utility, and distribution are carefully designed, it creates an economic engine that can sustain growth for years, giving investors confidence that the project is built on solid foundations. Number 3 is the on-chain metrics. When studying a cryptocurrency through fundamental analysis, one of the richest sources of insight comes directly from the blockchain itself. This is where on-chain metrics come into play. Unlike traditional markets where most company data is private, blockchains are transparent by design. Every transaction, wallet, and movement of coins is recorded on a public ledger, and this data can be analyzed to reveal the true health of a project. In other words, while price charts tell you how the market feels, on-chain metrics tell you what the market is actually doing. A good starting point is network activity. By looking at the number of active addresses, daily transactions, and transaction volume, you can gauge whether a network is actually being used or just existing on paper. For instance, Ethereum has consistently shown strong network activity, with millions of daily transactions powering everything from DeFi protocols to NFTs. This high level of real-world usage supports its long-term value. In contrast, there are many projects that raise hype during their launch, but their networks show little to no activity afterward. If no one is sending, receiving, or using the token in any meaningful way, it's a warning sign that the project may not be as strong as it looks on the surface. Another important metric is staking and validator participation. Many modern blockchains, such as Cardano, Solana, and Ethereum, after it switched to proof of stake, rely on validators who lock up their tokens to help secure the network. High staking participation generally indicates trust in the project because investors are willing to lock their funds for a return rather than just trading them for quick profits. For example, Cardano consistently shows a large percentage of ADA staked across thousands of validators, which reflects strong community involvement and decentralization. On the other hand, if only a handful of validators control most of the network, it could point to centralization risks and weaker fundamentals. One of the most revealing on-chain signals is whale concentration. Whales are addresses holding very large amounts of tokens. If a few whales control the majority of supply, it introduces a huge risk because any sudden sell-off could crash the price. For example, some meme coins see 80 to 90% of supply held by a handful of wallets, which often leads to devastating rug pulls when those wallets dump. Stronger projects usually have healthier distribution, with tokens spread across a wide user base. Bitcoin is a good example. Although whales exist, the distribution has gradually improved over the years, and no single entity controls the majority of coins. On-chain data can also reveal liquidity and transaction value. If people are moving millions of dollars worth of tokens every day, it suggests the network is trusted and active in real-world applications. Stablecoins like USDT and USDC are great examples. They show consistently high on-chain transaction volumes because they are widely used for payments, trading pairs, and remittances. By contrast, a token with extremely low transaction value is usually a sign of weak adoption, regardless of how strong the marketing may seem. Step by step, here's how you might approach on-chain analysis as part of FA. Step 1. Check active addresses and daily transaction counts to see if the network is alive. Step 2. Look at staking participation and validator distribution to assess security and decentralization. Step 3. Analyze whale concentration to spot risks of manipulation. Step 4. Review transaction volumes to see whether the token is actually being used. Consider this example. Suppose you are comparing two projects, Project A and Project B. Both have similar prices and market caps, and both are hyped on social media. When you check the charts, they look almost identical. But when you dig into the on-chain metrics, you find that Project A has tens of thousands of active wallets, a thriving staking community, and steady daily transaction volumes. Project B, however, has only a few hundred active addresses, almost no staking activity, and 70% of the supply locked in just 5 wallets. Which project would you trust more? Even if the price action looks the same today, Project A clearly has stronger fundamentals because the blockchain data proves that people are actually using it. In essence, on-chain metrics are like checking the pulse of a crypto project. They strip away the hype and speculation and show you whether a network is truly alive, growing, and trusted. By making on-chain analysis part of your fundamental research, you gain a powerful edge in identifying which projects have staying power and which ones are just empty shells. Number 4 is adoption and community. When evaluating a crypto project through fundamental analysis, adoption and community are two of the strongest indicators of long-term success. A cryptocurrency can have solid technology, fair tokenomics, and even healthy on-chain activity. But if people don't actually use it or believe in it, it risks fading into obscurity. In many ways, adoption shows us how useful a project is in the real world, while the community reflects how much belief and support it has from the people who matter most, its users. Let's begin with adoption. This refers to how widely the project is integrated and used beyond just trading on exchanges. For example, Bitcoin's adoption story is one of the main reasons it remains the #1 cryptocurrency. Major companies like Tesla, PayPal, and Square have accepted or integrated Bitcoin payments at different points, and countries like El Salvador have even declared it legal tender. These moves prove that Bitcoin isn't just an abstract idea, it has become part of the financial system. Similarly, Ethereum shows adoption in an entirely different way. Its blockchain is the foundation for countless decentralized applications, from DeFi platforms like Uniswap to NFT marketplaces like OpenSea. Every time someone interacts with these applications, they are indirectly driving adoption for Ethereum. On the other hand, projects with little or no adoption are risky. Imagine a new coin that promises to be the future of payments, but has no merchants, businesses, or apps actually using it. Without real adoption, its value is built mostly on speculation. That's why, when performing FA, you need to ask, where is this token being used, and who is integrating it? Strong adoption is usually visible in partnerships, ecosystem growth, and real-world utility. Now let's talk about the community. In crypto, community is often the lifeblood of a project. Because most cryptocurrencies are decentralized, there's usually no central authority controlling the project's success. Instead, the strength of the community, Developers, investors, enthusiasts, and everyday users drives the project forward. Think about Dogecoin. On paper, Dogecoin has weak fundamentals compared to projects like Ethereum or Cardano. Its tokenomics are inflationary, and its use case is limited. Yet Dogecoin has one of the most passionate and vocal communities in all of crypto. This community support alone has allowed it to survive for over a decade and achieve mainstream recognition, even being used for tipping and microtransactions online. A strong community also brings network effects, where the value of the project grows as more people use and support it. Take Polygon or Matic as an example. When it first launched, it was just one of many Ethereum scaling solutions. But because of its active community of developers and its partnerships with companies like Disney and Starbucks, Polygon has grown into one of the most widely used scaling platforms, processing millions of transactions. The community not only uses it, but also contributes to its growth, creating a cycle of adoption that strengthens its fundamentals. When analyzing adoption and community, here are a few practical steps you can take. Step 1. Look at partnership announcements and integrations. Are real companies or platforms using this token? Step 2. Check developer activity on platforms like GitHub. A thriving developer community is often a sign of long-term growth. Step 3. Explore social channels like Twitter, Telegram, or Reddit. Is the community active, engaged, and positive, or is it filled with bots and empty hype? Step 4. Observe ecosystem growth. Are new apps, projects, or tools being built on top of this blockchain? For instance, compare two projects, Project A and Project B. Project A has a small but loyal community and recently announced partnerships with a few fintech startups who are building apps on its blockchain. Project B, meanwhile, has a loud social media presence with lots of followers, but when you look closer, there's no real adoption. No apps, no integrations, just hype. While Project B might pump in the short term because of community noise, Project A has stronger fundamentals because its adoption is rooted in real-world utility. In summary, adoption and community are like the fuel that keeps a project running. Adoption ensures that the technology is useful, and community ensures that people care enough to keep it alive. Together, they create resilience, making it more likely for a project to survive bear markets and thrive in bull markets. For anyone practicing fundamental analysis, these two elements are essential signals of whether a cryptocurrency is just a passing trend or a long-term player. Number 5 is regulation and market sentiment. No matter how strong a crypto project's technology, tokenomics, and adoption may look, one factor you can't ignore is the influence of regulation and market sentiment. These two forces often act like invisible hands, shaping how the market values cryptocurrencies in ways that go beyond fundamentals. For investors using fundamental analysis, understanding these dynamics is key, because a great project can struggle if the regulatory environment or public perception turns against it. Let's start with regulation. Unlike traditional assets such as stocks or bonds, cryptocurrencies exist in a legal gray area in many parts of the world. Some governments embrace them, others tolerate them, and some outright ban them. These regulatory decisions can dramatically affect the long-term value of a project. For example, when China announced its crackdowns on Bitcoin mining in 2021, the immediate result was a sharp drop in Bitcoin's price and a massive relocation of miners to other countries. On the other hand, when countries like El Salvador declared Bitcoin as legal tender, it boosted global confidence in Bitcoin's long-term legitimacy. For newer projects, regulation can make the difference between thriving and dying. If a token is classified as a security by regulators, it may face stricter rules, limiting its ability to be listed on major exchanges or marketed to the public. This is exactly what we've seen with the US SEC targeting projects like Ripple's XRP, where years of lawsuits have slowed down adoption and scared away some investors, even though XRP still has strong utility in cross-border payments. So when analyzing fundamentals, it's not just about the tech. You must ask, how is the project navigating the legal environment, and are they prepared to comply with future regulations? Now, let's talk about market sentiment. Unlike regulation, which comes from governments and institutions, sentiment comes from people, the collective emotions and psychology of investors. In crypto, sentiment can often outweigh fundamentals in the short term. For example, a project could have strong adoption, fair tokenomics, and healthy activity, but if negative sentiment sweeps the market, say because of a major hack, a regulatory scare, or a global event, its price can plummet regardless of its underlying strength. Terra's collapse in 2022 is a good case study. For months, market sentiment was positive because of its high yields on the Anchor protocol. But when doubts spread about the sustainability of its algorithmic stablecoin, sentiment turned sharply negative, leading to a total crash. Sentiment can also create explosive growth. Consider how much attention projects like Shiba Inu or Pepe Coin have gained. Fundamentally, they don't offer much in terms of utility, but the community hype and viral sentiment turn them into multi-billion-dollar assets, at least temporarily. This shows us that while fundamental analysis focuses on the long-term health of a project, ignoring sentiment can blindside investors to short-term risks or opportunities. For fundamental analysts, the best approach is to combine both perspectives. Pay attention to regulatory trends, which countries are opening doors to crypto and which ones are tightening restrictions. Also monitor sentiment indicators, social media buzz, Google search trends, fear and greed indexes, and news cycles. These won't tell you the intrinsic value of a project, but they do show how the market might treat it in the near future. A practical example. Imagine you're analyzing a promising DeFi project. Its tokenomics are strong, its adoption is growing, and its on-chain metrics look healthy. From an FA perspective, it looks like a winner. But if regulators suddenly announce stricter rules on DeFi lending, or if sentiment turns fearful after a major hack in a competing protocol, the token's value could temporarily collapse. Knowing this, a smart investor would factor regulation and sentiment into their analysis, not to abandon the project, but to prepare for volatility, and maybe even use it as an opportunity to buy at a discount. In summary, regulation and sentiment remind us that crypto doesn't exist in a vacuum. It operates within the real world, where laws, policies, and emotions shape its value. A solid project with strong fundamentals may still face challenges if regulators step in or if sentiment turns sour, but by paying attention to these forces, you'll have a clearer, more complete view of the risks and opportunities in your investment decisions. Now that we've explored the core pillars of fundamental analysis, understanding the project, studying its tokenomics, analyzing on-chain data, looking at adoption and community strength, and considering regulation alongside market sentiment, you can already see how much depth goes into evaluating a cryptocurrency beyond the price chart. Each of these elements helps us build a clearer picture of whether a project is positioned for long-term success or if it's just another short-lived trend. But knowing how to analyze these pieces is only half the story. The real question is, why does all of this matter? Why should investors spend the extra effort researching fundamentals when quick profits can be made just by following the charts or the hype? This is where we move into the next part of our discussion: why fundamental analysis matters in crypto. Understanding the why gives us the conviction to trust our research, stay grounded during market swings, and separate true opportunities from empty promises. Let's break it down. In the world of cryptocurrency, where volatility is the norm and prices can swing dramatically within hours, it's tempting to rely only on short-term signals like charts, trends, and social media buzz. But without fundamental analysis, an investor risks being swept away by hype, making decisions based on noise rather than substance. This is why FA matters so much in crypto. It provides a foundation of knowledge and conviction that helps you see beyond the daily price movements and focus on the long-term value of a project. One of the most important reasons FA matters is because it helps you identify strong projects early. The truth is, many of the cryptocurrencies that exist today will not be around 5 or 10 years from now. Just like in the dot-com bubble of the early 2000s, thousands of internet startups launched, but only a few giants like Amazon and Google survived and went on to dominate. crypto is in a similar stage of evolution. By applying fundamental analysis, you can spot projects with real utility, strong communities, and sustainable tokenomics long before they become household names. Imagine the investors who studied Ethereum in 2015, understood its vision for decentralized applications, and bought ETH when it was under $1. Their conviction, rooted in FA, allowed them to hold through volatility and reap massive rewards later. FA also protects you from scams and hype-driven projects. The crypto space is notorious for rug pulls, pump and dumps, and tokens designed purely to exploit investor greed. Without FA, it's easy to fall victim to marketing campaigns that make every coin look like the next Bitcoin. But with FA, you're equipped to ask tougher questions. Does this project solve a real problem? Who controls the supply? Is the team credible and transparent? A simple review of fundamentals could have saved thousands of investors from losses in projects like BitConnect or OneCoin, which promised extraordinary returns but collapsed because they had no genuine value. Another reason FA matters is because it gives you confidence during market volatility. Crypto is famous for its emotional roller coasters. Prices pump rapidly, then crash just as fast. Without a solid foundation, investors often panic sell in fear or chase pumps out of greed. But when you've done your homework, you can separate temporary price action from long-term value. For example, during the 2018 bear market, Bitcoin crashed from nearly $20,000 to below $4,000. Many people who only looked at charts or followed hype lost faith and exited the market. But those who understood Bitcoin's fundamentals, its fixed supply, increasing adoption, and growing network security, saw the downturn as an opportunity rather than a death sentence. By relying on FA, they held on, and today, Bitcoin trades far above those lows. FA also helps you filter through competition in crowded sectors. In crypto, it's common to see dozens of projects claiming to do the same thing, whether it's DeFi lending, Layer 2 scaling, or privacy solutions. Without FA, you might treat them all as equal, but deeper research can reveal which ones actually have the technology, partnerships, and community to dominate their niche. For instance, in the decentralized exchange, or DEX, space, many platforms emerged around 2020. On the surface, they all looked similar, but FA showed that Uniswap had the strongest developer activity, liquidity, and adoption. As a result, it became the leader, while many competitors faded into obscurity. Lastly, FA matters because it builds long-term investment discipline. Crypto can feel like a casino if you only rely on speculation. Prices go up and down based on emotion, and it's easy to get caught chasing the next big thing. FA gives you a strategy grounded in research. Instead of following hype cycles blindly, you can make informed decisions about what to hold, when to accumulate, and which projects align with your long-term goals. This doesn't mean you'll always be right, but it means your decisions will be based on logic rather than emotion. Think of FA as your compass in the chaotic world of crypto. It doesn't eliminate risk, no analysis can, but it helps you navigate uncertainty with clarity. It allows you to focus on projects that have the strength to survive market cycles, the utility to attract adoption, and the community to thrive in the future. Without FA, investing in crypto is like sailing without a map, vulnerable to every storm. With FA, you're not just guessing where the winds will blow, you're charting a course towards sustainable opportunities. So far, we've seen how powerful fundamental analysis can be in crypto. It helps us spot strong projects early, avoid scams, and build confidence when markets get shaky. But as valuable as FA is, it's not a perfect tool. The crypto space moves at lightning speed, and sometimes even the best research can't prepare us for sudden changes. This is why it's equally important to understand the limitations of FA, what it can't do, where it can mislead, and how to balance it with other forms of analysis. By recognizing these limitations, we can use FA more wisely and avoid falling into the trap of thinking it guarantees success. While fundamental analysis is one of the most important tools for evaluating cryptocurrencies, it's not a magic formula that guarantees perfect results. In fact, one of the biggest mistakes new investors make is assuming that if they've done their FA correctly, the market will immediately reward them. The reality is more complex. Crypto is a young, rapidly evolving space, and there are certain limitations that every investor must keep in mind when relying on FA. The first limitation is that crypto information can become outdated very quickly. Unlike traditional companies that release quarterly reports and operate in relatively stable industries, blockchain projects often move at lightning speed. A white paper that looks solid today might be irrelevant a year later if the project pivots, the team dissolves, or a competitor introduces better technology. For example, many ICOs in 2017 had impressive roadmaps that promised revolutionary platforms, but within a couple of years, most of them either abandoned their original vision or couldn't deliver on their promises. If you based your FA purely on those early documents, you would have been misled by outdated information. Another limitation is that market sentiment can override fundamentals in the short term. You might identify a strong project with solid adoption and healthy tokenomics, but if the overall market mood is bearish, the token's price can still crash. A good example is Ethereum during the 2018 bear market. Fundamentally, Ethereum was growing. Developers were building dApps and the ecosystem was expanding, but ETH still lost more than 80% of its value because fear dominated the market. In crypto, emotions move faster than logic, so FA doesn't always align with immediate price action. A third limitation is the difficulty of valuing innovation. Many crypto projects are building technologies and systems that have never existed before. How do you put a fair value on a decentralized identity network or a blockchain gaming platform that hasn't yet achieved mass adoption? In traditional finance, analysts can compare companies to existing peers, look at revenue multiples, or study decades of industry data. In crypto, there are often no historical benchmarks, which means FA requires more assumptions and sometimes educated guesswork. This uncertainty can make your analysis less precise. FA is also limited by data reliability. While blockchain data is transparent, not all metrics are easy to interpret. For instance, the number of active addresses might look impressive, but it could be inflated by bots or repetitive transactions from the same users. Similarly, high transaction volume doesn't always mean real adoption. It could be the result of wash trading or manipulation. If you take these numbers at face value without digging deeper, your analysis might give you a false sense of confidence. Finally, FA requires a long-term mindset, which can be frustrating in a market dominated by short-term trading. Many investors turn to FA to find projects worth holding for years, but in crypto, patience can feel like a disadvantage when others are chasing quick pumps. For example, someone who thoroughly researched Polkadot might have strong conviction in its long-term potential, but in the short term, meme coins with weaker fundamentals might outperform it in price. This doesn't mean FA is wrong, it simply means that fundamentals take time to reflect in the market, and they don't always match short-term momentum. In summary, the limitations of FA remind us that while it is an essential tool, it should never be the only tool. It helps you identify long-term winners and avoid obvious risks, but it can't predict sudden regulatory changes, market panics, or the pace of innovation. The best approach is to balance FA with other strategies, like technical analysis for timing entries and sentiment analysis for understanding short-term trends. That way, you're not relying on FA as a crystal ball, but as a compass that guides you in the right direction while still adapting to the unpredictable nature of the crypto market. At the end of the day, fundamental analysis is what separates speculation from informed decision-making in crypto. It's the process of digging beneath the surface, asking tough questions, and understanding what truly drives value in a project. We've seen how FA helps investors identify promising opportunities early, avoid scams, and build the confidence needed to hold through volatility. We've also acknowledged that FA isn't perfect, it has limitations, and it works best when combined with other tools like technical analysis and sentiment analysis. The key takeaway is this. In a market as unpredictable as crypto, fundamentals act as your anchor. They don't guarantee overnight success, but they give you a framework to separate hype from reality, short-term noise from long-term potential. Think of it as building your investment strategy on solid ground instead of quicksand. So whether you're just starting your journey or refining your skills as a crypto investor, make FA a part of your toolkit. The deeper you understand the projects you invest in, the better equipped you'll be to navigate both bull runs and bear markets with confidence. If you found this explanation helpful, don't forget to like this video, subscribe to Crypto Education Zone, and hit the notification bell so you never miss out on more insights. And remember, knowledge is your greatest asset in this space. Keep learning, keep questioning, and keep building your conviction.